The UK's Bank of England has just announced that it will leave interest rates unchanged at 5.25%. This follows the U.S. Federal Reserve also pausing rate hikes yesterday. The Fed is seeking to reduce inflation, which is currently at 3.7%. The bank wants to get that rate down to 2%. And although the Fed isn't boosting rates, for now, borrowing costs are at their highest levels in 22 years. So joining me now to discuss is Martin Bakkerdax. He is a senior editor and chief markets correspondent at financial news website The Street. Thanks for joining us. We're going to get to what's happening across the pond in England, but I want to start right here. Did this move by the Fed surprise you at all? The Federal Reserve has a tendency to broadcast what they're going to do. So did this come as a surprise?
It did not, and I think you're precisely right in saying that the Fed has been very diligent over the past years in walking the street up, as we like to say in market parlance, into what it is intending to do. So I think the anticipation was that they were going to stay put, and that's exactly what they did. Where the surprise did come from, I think, was in the projections as to how different rate setting officials see the economy evolving over the next few months. They actually doubled their forecast for GDP growth. That's indicative of what we're all seeing in the broader economy. And they also trimmed the forecast for inflation and for unemployment. Now, when you mix those together, that all comes up into a sort of batch of assumption that we are going to see faster inflation. So from that, markets interpreted that there could be one more rate hike between now and the end of the year as a result.
That is interesting. And so did the markets react at all to the news? Or how did they react?
Yes, indeed. We had a significant sell-off in stock prices last night, and we're seeing that again this morning in pre-market trading. But I think the most significant moves, Anne-Marie, were in the currency market and the bond market. The US dollar now is trading at the highest levels in about 6 months against its major global peers, and that is very significant. And we are seeing US Treasury bond yields at the highest levels since 2007. And that's very, very important, particularly for the 10-year Treasury notes, because they are tied to mortgage rates. And you talked just prior to the introduction about the way that Americans are sort of adapting to these higher rates and actually increasing mortgage applications.
Yeah.
What we are seeing now as a result of the bond market move is that investors anticipate that interest rates will not only stay higher, they'll also stay there for a longer period of time. So the American consumer is going to have to get more comfortable with this high interest rate environment, and that could slow economic activity over the coming months.
So then the question is, right? When I saw that they were freezing it, I thought to myself, this is hopefully how you get to the elusive soft landing. You can bring inflation down without throwing us into a recession. I mean, what is the general feeling that that soft landing is possible?
It really was an important part of the conversation yesterday. And Federal Reserve Chairman Jerome Powell said that while it was not the baseline assumption of the central bank, it was certainly an ambition. And he's been saying that for a number of months now. He's much closer to that ambition, I think, than anyone would have anticipated. The Atlanta Federal Reserve has a real-time tracker of economic growth, and it suggests that we are advancing at about a 5.9% pace, excuse me, a 4.9% pace. That is extraordinarily good. Unemployment is at the lowest rates that we've seen in about 4 or 5 decades. And the stock market, despite the sell-off we've seen over the past few weeks, is still up very, very strongly for most of the year. So the economic performance has surprised virtually everyone, and it's come in the face of these relentless interest rate increases. So with that in mind, it does suggest that that soft landing is something that's perhaps more likely than it was even a few months ago.
Fingers crossed, fingers crossed. And as I understand it, something else that came as a surprise in the UK is that inflation had dropped. And
Yes.
so I guess I wasn't particularly surprised to see that the Bank of England had also paused interest rate hikes. Not only do they tend to follow the Federal Reserve here, but they got a really good reason because interest rates seem to have, moved.
Yes, we had a bit of a pullback in inflation in the United Kingdom, and that was represented from data earlier this week. But it has to be remembered that while US inflation is ticking around 3.7%, it's 6.7% in the United Kingdom. There's a whole host of factors that go into that, Brexit being one of them, but that's still triple the target of the Bank of England. So the fact that they did hold rates today was somewhat, but not a great surprise.
All
What I
right.
think it indicates, Marie, though, is that we're seeing central banks around the world now possibly reaching the peak of their tightening cycles. And that suggests not great news, because once they stop raising interest rates, it probably means that they see economic weakness over the horizon. Much
Well,
of it is emanating from China, but also from Europe as well. So we do have quite a bit of uncertainty going into the final months of the
well,
year.
I know the stock markets don't like uncertainty. Martin, thank you very
Not
much.